Hello, everybody. Welcome back. This is our symposium that we try to accommodate and to boost research productivity and to build our STR community. So what I would like to do is to start with a quick reminder of our events. So today we have our June event that's on resources, capabilities, and strategic factor markets. And we're going to have a very exciting panel of speakers and discussants. Then later in July, we have our final event of the 2020-2021 series that's on research methods. This is a research methods special symposium where we're going to have editor perspectives on alternatives to the hypodeductive framework in empirical management research. So I look forward to seeing you on July 14th. I'm going to then ask Paul Nary, who is the event co-organizer, to introduce our speakers. Go ahead, Paul.
Thank you so much, Gwen, and thank you for all the help organizing this. So welcome, everybody. Really excited about the symposium today. We're going to talk about lots of different aspects of limits and idiosyncrasies of public markets and public corporations. And we have a great lineup with us today. Really, none of them need any introduction. We have Gautam Ahuja from Cornell University. We have Mary Banner from the University of Minnesota, as well as Todd Zenger of the University of Utah. And we will start with Gautam presenting his paper on corporate ownership and research risk taken. Go ahead, Gautam.
All right, so before our speaker kicks off, we would like to have a group photo. So if you don't mind turning on your camera, we're going to capture our memory of what we look like back in 2021, a very special year. So I'm going to ask Zhao, our task force leader. Yes?
Yeah, one more second. If you're dressed from waist up, please turn on your camera. And we'll take a photo. 1, 2, 3, say cheese.
Cheese.
We got it. Thank you. Back to you.
All right. Thank you, Zhao. All right. So now it is my honor to pass this presentation to Gautam.
Thank you very much, folks. Thank you so much, Gwen. And in the interest of time, I'm going to jump right in and try to sort of lay out the basic ideas of the paper without actually getting too much into the details on the empirics, simply because in about 15, 17 minutes, it's very difficult to do both. So the title begins with a question, and I want to note the question mark because we're not claiming something yet, but we are raising a question about it. Is you get what you pay for, the rise of the passive investor and exploration and R&D. Cassidy is my co-author, and she is there on the Zoom group with us. So, and she can help me wherever I sort of run into trouble. Okay, so very quickly, I mean, this is the broad structure: research question, motivation, etc. I'm going to skip through a lot of the stuff in the interest of time and focus a little bit more on the first, second, third, and sort of second to last aspects of the paper. Okay, so the question is fairly straightforward: how do passive institutional investors constrain or enable R&D exploration in publicly held firms? The point to note about the question is that the primary focus of this research is not on whether they facilitate or inhibit R&D, which is the question about the quantum of research, but also whether they influence the direction of research. In other words, do they make managers more willing to take on riskier projects or less willing to do so? And that is the idea, is that it's looking at R&D exploration as the primary focus of interest here. Now, why do this research at all? And there are multiple reasons. I'm picking on 3 here. This is why institutional investors. Why passive institutional investors? For those of you that are not as familiar with the institutional investor world, think of them as index funds, because that is precisely what they are. And then why focus on R&D exploration at all, as opposed to some other outcome variable? So Why institutional investors? That's something that an audience in this setting would be well familiar with, that there is a classic agency problem going back all the way to Burlean means. That basically the Burlean means argument was that with fragmented shareholders, they have neither the incentives nor the ability to control managers, and managers de facto get away with whatever they would prefer to. So the corporate behavior reflects managerial preferences, not shareholder preferences. And this has been around with us from at least 1932 or even before. But we're making the case, or following the case, that this problem now has renewed contours, and that's really the interest, why this issue is of interest once again, and in a very current fashion. And this is basically because recent research has suggested that there is a possible alleviation of this problem through institutional shareholders. Institutional shareholders, since they're also block holders of shares, have both the ability and the incentive. Since they hold a large amount of stock, they have the incentive to monitor closely. And they also have expertise that they can bring to the table in terms of monitoring. And this can thereby, sort of help them monitor managers and direct them more effectively. Specifically, the long-standing Burlean means problem is that managers will tend to do things that are less riskier than shareholders might want them to do, is a problem that can be addressed. And most notably, there was a paper in AER in 2013 by Ahuja, Van Reenen, and Zingales, which made the case that managers will swing for the fences. They take required risks, and they demonstrated there were patenting and R&D increases as institutional investors increase their shareholding. But on the other side of this debate are other finance and legal scholars who said that, this incentives and ability might be a bit overrated. And so this paper kind of fits directly into this debate by saying, okay, which of it is it? Are they better? Are they worse? And as we know, the answer to all of these questions is it depends. And so we're going to pick one certain arena of where it depends and raise a set of questions about it or issues about it, okay? Why passive institutional investors? Because with apologies to Willie Sutton, the famous bank robber, that's where the money is. And if you think about it from that perspective, the index fund as an investment vehicle has been an incredible success. It combines portfolio breadth, so you don't have to predict who wins. You have everything in the portfolio. And it has really low costs, right? And these ideas about, index funds have actually, their classic tagline is, it's the fee is stupid, and you have this wonderful quote from Bogle about what index funds stand for and so on and so forth. And you can see that index funds have actually done, or actually institutional investors more broadly have done, have taken a large share of the market from the household sector, which has steadily declined over the last 20 odd years. But within this sector, there's a massive increase in equity that is passively managed by index funds. And you can see that line go straight up and continue to go up even with more current data. So the conceptual argument or reason that we want to look at passive institutional investors is, one, of course, is the practical one, that they're really big. So you want to go where the action is that they have two faces. And perhaps a lot of the attention has gone to the first face, which is that low expense ratios in index funds help to juice up returns, and that makes for them becoming a great investment vehicle. What we're going to focus on is the flip side of this. Low expense ratios are also what we would call the governance cost budget. And index funds are also, by default, owners of corporations. So the question is, when you have an owner whose resources are very constrained, does that imply that the quality of the product that they're supposed to produce, which in this case is governance, is also going to get affected? And that's the reason we ask the question, you get what you pay for, right? You can see that this expense ratio is actually be going down a lot. I won't spend too much time on it. Why exploration? There's a variety of reasons why we want to study exploration or research, R&D exploration more specifically. But the most important reason here is that it is an arena of potential conflict between owners and managers. Managers may prefer to take fewer risks. Owners may prefer to have them take more risks. Why managers will prefer to take lower risks, we don't get into right now, but there's a variety of career concerns, et cetera, that come to play that the literature has established well. And this is then a great context to evaluate the viability of the institutional investor solution to the Boolean means problem. And that is the reason we go after R&D exploration. Okay. Now let me go to the basic arguments underlying our question. So we use decoupling theory as a lens for this institutional investors address the Boolean means problem issue, right? We know that prior corporate governance research, Westphal and Park summarized an incredible amount of this past research in their 2020 book. Whenever there's an innovation or an attempt at governance improvement, there's almost a set pattern that emerges. Regulators, markets or owners create pressures through innovations and changes in the environment with specific objectives in mind. So pay for performance, stock buybacks, blah, blah. But eventually, those objectives are often not realized or are realized but accompanied by unintended consequences. So innovate to control managers better, but then what you see finally is something, not exactly what you intend to do. And this difference is often underwritten by what's called decoupling behavior by the managers, right? So just applying that lens to the particular problem, we know that the new contours of the B&M problem have led to the suggestion that institutional ownership, with its concentration of power, can rectify the power imbalance that favored managers and facilitate long-term oriented behavior. And swinging for the fences is the phrase that we use following AVZ. Yet, the decoupling literature suggests that whenever managers are faced with such pressures, they respond with appropriate compensating or self-seeking behaviors, often separating or delinking form from substance. Hence, decoupling might present an interesting way to understand the issue. But we don't just use decoupling to understand the issue of institutional investors. We use decoupling also we use this question also as an opportunity to sort of push into the understanding of decoupling itself. One of the issues that has been underemphasized in the decoupling literature is that when managers do these kinds of things where they are able to sort of decouple, audiences that they are trying to sort of target and address with this seem to accept it, or at least there is not a pushback in that fashion. And that raises the question that when managers or organizations decouple, why don't the audiences that are the targets of this behavior call it out or react in some fashion, in a more timely fashion than they have, etc. Right? And we see that our theorizing and our context actually provides us with an interesting answer to this second sort of theory-oriented question also. We note that in our context, we have essentially two types of actors and two types of distinct institutional problems. On the one hand, you have the managers, and on the other, you have the index funds. What this provides us is with an opportunity to understand why do the sources of institutional pressure not really confront the decoupling. And as you will see in our arguments in the next 3 or 4 slides is, we introduce the notion of multi-level decoupling. Decoupling behavior of one set of actors in response to institutional pressures then coincides with decoupling behavior by those that are the source of the institutional pressures. And when you have this kind of sequential or multi-level decoupling, then the ability of sort of the good cops, so to speak, the sources of the institutional pressure to actually address the behavior of, for lack of a better term, I'm going to use a shorter term, I'll just use agent in a particular fashion. And the reason for that is that decoupling works by separating form from substance. But when the form is not the substance, so when you have essentially a situation where the managers are decoupling because of the pressures they face from their institutional sort of environment, we also find that the index funds are decoupling because of the pressure they face from their institutional environment. And both of these sides are essentially using what we would call, this decoupling approach, which is separating form from substance. And when both of these things happen, we have at least one explanation why the source of institutional pressure does not actually, rectify or ameliorate the problem in the with the managerial decoupling in this case. Because separating form from substance means that the form lacking substance often leaves them incapable of exerting the appropriate behavior. Our work also draws attention to the fact that they may actually also simply lack the resources to identify or confront such behavior. Okay, so let me elaborate on this core idea a little bit further. So what are the two problems? The manager's problem is that they face normative pressures. They're in an R&D intensive industry. Investing is regarded as, in R&D, is regarded as good long-term oriented behavior in technology intensive industries. There's a fair literature on this going back all the way to Brian Bushy almost 20 years ago. They also face some level of coercive pressures from their owners, which are essentially the institutional or retail investors, but our purpose would be institutional investors. Passive owners are very cognizant of their responsibilities and encourage long-term orientation in the companies they own. One phrase they use, and this is used by one of the main players in this game, is we are the ultimate long-term investors, we cannot exit. So they want to establish to the firms that they own that this has to be done, long-term orientation is to be met. But against these pressures, the classic decoupling situation arises when the self-interest differs. And the self-interest of the managers is that research risk-taking can be dangerous for employment prospects, again, established through a long past history. And secondly, passive owners actually need liquidity in the stocks of the index to facilitate redemptions. And this itself, for reasons that we identify in detail in the paper, militates against highly uncertain investments. So what is the manager to do? You've got these pressures, both normative and coercive, and then you've got self-interest on the other side. The solution is decoupling. You comply in form, but deviate in substance. You continue to invest in research, keeping R&D and patenting frequency high because these are visible and measurable indicators of long-term risk-taking. But you modify the research direction to embody less risk, focus on local search and incremental innovation, and eschew or reduce distant search or breakthrough innovation. Okay? Similarly, the passive or the index fund owner has their own problem. See, index fund owners are also responsible to the society or public at large. And one critique that has been levied against them is that they are absentee landlords. So, and that's captured in the phrase, passive investors should not be passive owners, right? They also have a second normative pressure to conform with category legitimacy. They claim the basis for this is, basically they are the low-cost people in this game. They save the investor money. And a classic tagline they use is, it's the fee is stupid, right? That means they need to conform to low expense ratios. Okay. In addition to that, purely from the mandates that they get from their investors, their coercive pressures as well. They need to conform to the governing index and hold a large number of stocks. Now, against these normative and coercive pressures, there is this issue of self-interest. They need to remain competitive in a perfect commodity business. Remember, index funds need to hold everything on that index. So even if they do some, governance, research, etc., or come up with ways to investigate stuff and manage their companies better, there's very little return to it because those benefits will flow to everybody that's an owner of that stock, including other index funds who are their competitors. So what is their solution? Their solution is, again, the same as the managers. They decouple. They limit compliance and substance. So they limit governance cost and therefore don't provide customized or detailed individual firm governance. But they ensure compliance and form by promoting very visible homilies of good governance. They ask firms to increase disclosure, more frequent reporting, promote dividends, all visible and easy to measure things, but not necessarily the best things for technology intensive firms. Okay. And so now you can see that there are basically this notion of multi-level decoupling draws attention to these two types of problems that these two types of players face and how they solve. Managers at the margin decouple exploration from research, make research more exploitative and less exploratory. Owners decouple at the margin, in terms of governance from, and separate governance from ownership by using low intensity forms of governance, which may be ill-equipped to monitor closely, okay? Putting the two solutions together, we have two predictions or refutable implications of these arguments. The first is that higher index fund ownership will move the firm towards exploitative rather than exploratory research. And the second is, cognizant of the legitimacy pressures, firms will, high index fund owned firms will nevertheless conduct high levels of R&D and patenting, and at least not decline from where they were earlier. I won't get into the details of some of these empirics. The data span 1991 to 2015, which is the 2015 restriction is because of patent data not being available after that. A bunch of other data sources, which I will not get too much into. We've also done this whole exercise with a smaller set of, with the older patent data, which was a 15-year period. Now we've replicated it for all 25 years. We have done this exercise both for technology intensive industries and then for the entire corporate, corporate sector. So here I'm reporting the first, but all manufacturing industries are also captured, and our results are very similar. They do not change very much. In terms of the empirics, we look at exploratory patterns, which is a summation of potentially radical, potentially, that's the Asim Cole and JP Eggers measure, measures of patent citing unfamiliar technology and patent citing technology that's new to the world. Unfamiliar technology is new to the company, and we have justifications for why this happens, and so on and so forth. And we then basically, there's a bunch of endogeneity concerns that can arise, and we address those. Most obvious measurement error possibility here is the misclassification of funds. There's also a treatment versus selection effect issue. Our claim is about treatment, but maybe there's a selection problem that index funds, the indices themselves pick firms that are more likely to be, of a certain kind, and so on and so forth. And we explore all of that in detail. But here are the results, basically. So you can see that as index ownership increases, the top panel shows us that exploitative patents don't decline at all, but exploratory patents do. The R&D itself, which will come in a separate, and so basically you see that the patents themselves, you don't see a very significant change at all. But on exploratory patents, you see a very significant and notable and statistically and economically significant drop, okay? We look at the same pattern in R&D. Actually, the difference is not statistically significant, and R&D marginally increases, but as I mentioned, it's not statistically significant. So what are basically the contributions here? So the first part here is that we say is that, and this is why we say it changes the contours of the Burlean means problem. The old Burlean means problem was fragmented shareholders did not have the resources to pursue because their interests were too narrow in terms of equity ownership, and they had no expertise. The new version of it is, unfortunately, is that while the shareholders such as passive funds are becoming bigger owners, they no longer have the original fragmentation constraint, but because of the focus on low expense ratios and needing to hold large numbers of stocks, they again have very limited resources for corporate stewardship. And what's more is that incentives don't favor it because they are selling a perfect commodity product and there is free riding all the way across. Okay, so if they invest in something, they never get the return for it because that investment will be, the benefit will be appropriated by all index funds, not by their own index fund, not by them themselves. Second issue that this addresses is that decoupling theory raises an important puzzle. Why were decoupling solutions not caught by their audiences? And we think that multi-level decoupling may provide at least one explanation. Our results also, or our argumentation also identified resource constraints as a second possibility, which appears in this context, but may or may not appear in other contexts. Right? Third part that we draw attention to is this, a very significant part of the way that index funds do corporate governance is by essentially pushing a lot of what are called good governance practices. However, when we examine those good governance practices from the context of a 21st century digital technology intensive economy, many of those practices come up short. And there is literature in the finance area also, we see Lee's paper, etc., which has identified some of similar things. And more broadly, Mary's work and Asim's work has also drawn attention to, and Paul's work has also drawn attention to this phenomenon more generally. Basically, the question that arises is, are the generals fighting the last war? That dampening down on free cash flow is perhaps not the best way to govern these companies, and so on. And we also have a contribution to the organization, learning literature, etc. But I'll stop here. Thank you.
Thank you, Gautam. This is very interesting. It stimulates a lot of thoughts on compliance, on disclosure, and thinking this is a result of these multi-level decoupling. Fascinating. And if you have any questions for Gautam or for Cassidy, please feel free to put them in the chat room. At the end of all the presentations, we will come back to have a conversation. Our next speaker is Paul. Take it away.
All right, thank you so much. Let me know if you can't hear me or can't see the presentation. But let's see, here we are. Okay, so today I'm going to talk a little bit about the general phenomena and research into private equity, as well as a specific study that's kind of one of many that I'm currently working on in this area. Okay, sorry. So why do we care about private equity? Well, I think this is a huge phenomenon that's been very much growing in size and its prominence and importance. As you can see from the headline, this is really becoming a private equities world for all of us. And as you can see from the chart on the left, the assets under private equity management have basically exploded compared to the overall asset value of public corporations. But I would also argue that although the phenomenon itself is important, and here I'm talking primarily about non-venture private equity, so not venture capital, but sort of leveraged buyout private equity firms like KKR, Blackstone, and so forth. And basically, I would argue that this phenomenon is still rather understudied by management scholars. Of course, we do have some research, some of it going back decades into sort of the early form of leverage buyouts and early private equity firms. We also have some research into private equity as a very distinct organizational form, even when compared to something like a well-diversified conglomerate. We have work by people in this room like Mary and Todd on why some firms do better under private rather than public ownership. There are some studies out there looking at overall private equity business model, as well as sort of whether there is a corporate effect, for example, to private equity ownership. And finally, there's also this newer stream of literature that looks at role and behavior of private equity in markets for corporate control as a distinct governance form, as well as into its effects on other players in the markets, public markets, shareholders, and public corporations. So going further into the stream, this is where some of my own work has been. And sort of the main thing here is that private equity firms are becoming, again, increasingly prominent in markets for corporate assets, especially, as I'll explain in the next couple of slides, where they can take advantage of various frictions, which I'll explain a little bit more. They're also especially active in the markets for divested assets. This is actually where the majority of interactions between private equity firms and public corporations occur. Something like almost 80% of all transactions of private equity firms with public corporations are when a private equity firm acquires a unit or a carve out of a public firm. And then finally, there's also this rapid change and rapid growth in different types of PE transactions. I have another project that looks at the influx of private equity and private equity buyouts in high-tech industries. So for example, now something like almost 40% of all buyouts of software firms and other high-tech firms are actually done by private equity firms. So we're very much seeing private equity basically coming into any space where they can make their business model work. So originally I was going to present this theory paper that sort of provides kind of a unified theoretical framework for when and how private equity works and when it's able to create and capture value in the markets for corporate assets. But instead, I'll actually talk a little bit, since the study has now been published in AMR, I'm actually going to talk a little bit more about a current empirical study, which actually looks at a specific context where some of these mechanisms are working. So what I want to highlight here is that in this AMR paper, we really described three main sets of advantages that private equity may have when there are certain frictions in the market. So for example, where other actors, for example, strategic buyers, cannot fully ascertain a value of a business that private equity can actually value better than them. Sometimes they may have a governance advantage when they can actually improve the value of a business when they, for example, take it out of the sort of the tyranny of quarterly earnings and kind of the things that Gautam was referring to. And there is also potentially this timing advantage when a unit is up for sale, but no strategic owner is actually in the market to acquire today, when private equity may play this brokerage role where they buy today, sell tomorrow. And underneath it all, we also mentioned this aspect of potential bargaining or experience advantage to private equity, especially as they become experienced in certain types of transactions or certain types of the market, certain corners of the market, sorry. So the research question that I investigate empirically in the study that I'm about to switch to is whether public corporations perform better or worse when they divest to private equity firms rather than to other strategic or corporate acquirers. And if there is a difference there, then why is there a difference and what mechanism specifically may explain it? So let me give you a research summary before sort of going into all the details, as I'm not going to cover all of it in the time that we have left. So in this study, I compared performance of divestitures to private equity firms versus divestitures to corporate acquirers from the perspective of a divesting firm. I have a sample of over 1,000 of divestitures by public US firms in the manufacturing sector. And I basically find that private equity buyouts underperform buyouts, or rather divestitures to other corporate buyers in the short term, but not in the long term. I also find that buyouts of by firms that are themselves owned by private equity firms are actually much more similar to acquisitions by strategic buyers in their performance, and there is no negative effect to these transactions. I also find that the results are generally robust and hold when conditional on divestitures to private equity specifically, and sort of do a lot of robustness checks and try different model specifications here, trying to sort of basically account for the selection and other aspects of the endogeneity here, and find that selection alone, so the difference in the types of businesses that are sold to private equity firms versus those sold to public firms, does not seem to explain the negative performance alone. So there's something else that's potentially happening here that can be interesting, and there's a lot more heterogeneity to explore. So this is a paper that has an R&R and SMJ, and we actually have a set of great reviewers that gave very good feedback on sort of moving this project forward, but this is still an early stage project, so there is still a lot of work to be done. So would definitely appreciate any feedback that you may have for this. Okay, so going into it. So what's the theoretical motivation for this project? And I'm going to go through this reasonably fast because I think I touched on much of it, sort of looking at the general phenomena. Here, basically, there's been a lot, of course, of interest in performance effects of corporate restructuring, a lot of papers and work going back decades. And now we know that divestitures are really one of the most important restructuring tools for companies. So they're certainly important. There's been a lot of work here done by Emily and others on sort of why divestitures are important when divestitures tend to improve or hurt corporate performance. We also know that in general, divestitures seem to have a positive effect on firm performance. This is from both strategy and finance literatures. But there's still some mixed results, which is not surprising because it turns out that divestitures are highly heterogeneous. Counterparty matters, the type of a divestiture matters, the type of a transaction, the impetus for the transaction. All of those things matter to the performance or even sort of appearance of these transactions. And at the same time, we also know that private equity firms are becoming ever more active in this market for divested assets. This was our paper in 2018 with Asim and Harbir, where we also found that private equity firms seem to target different types of units, distinct types of businesses from corporate acquirers, which is again why selection and thinking about what types of divestitures private equity targets versus those targeted by strategic buyers becomes very important, and why I try to empirically investigate it. And again, there's also been this growing interest in private equity behavior in public markets and what it means for just about everybody involved. Again, just to go back to the phenomenon and explain why I think this is important and interesting and relevant for strategy scholars. Again, I'm not going to go through this in much detail, but private equity is huge. It's everywhere. It owns a ton of different firms. And moreover, since the model is large, is not permanent ownership, you see a lot of firms rotating through private equity portfolios. And moreover, as I've pointed out, acquisitions of divested units are huge for private equity and again, comprise the vast majority of their interactions with public corporations. So most of interactions that private equity has are when private equity firms buy units and divestitures of public corporations. And moreover, private equity firms just simply love divestitures, right? They always try to acquire as many divestitures as possible. They encourage corporations to see them as the divestiture partner of choice. So, go to just about any a private equity website and you'll see these solicitations for, acquisitions of divestitures will help you sort of do these carve outs, will help you prune your corporate portfolio. We're professionals, we know what we're doing, we can do this quickly and efficiently. And again, this is just about every private equity firm out there. But to go back to the actual study and to the actual empirics, so what really happens in terms of performance when public firms divest to private equity? Well, this is raw data of short-term market reactions to these transactions. And on the left, there are normal divestitures to corporate acquirers, where you see the sort of performance increase that's expected if you follow the literature. And on the right, you have divestitures to private equity companies, where you clearly see that it's not the same performance. The trend looks a little bit different prior to the day of the event, but these differences are not statistically significantly different. But there is certainly a statistically significant difference between returns to these transactions, their short-term performance, at least when it comes to the market reaction. So why is this happening? What are some potential mechanisms at work here that may explain why there are differences in performance of these divestitures to private equity companies? Well, the corporate acquirers, of course, are generally looking for resource-based synergies, while private equity buyers, again, according to even our own research, seem to target very different units, usually non-core units, units that have been neglected or mismanaged, basically where there's opportunity to create and capture value. Also, again, following the theoretical framework that I've presented earlier, private equity buyers seem more likely than an average corporation to have superior selection, valuation, operational improvement, and timing and brokerage capabilities. And they also seem to oftentimes have a stronger overall bargaining position due to a variety of factors. I talk to investors, PE managers, financial intermediaries all the time. And the stories that I hear about how shrewd private equity companies are when it comes to these transactions are absolutely incredible. They just have this ability to align incentives and sort of maximize all the value that they can create and capture in these transactions. And oftentimes it sounds like when you're a corporation that's simply looking to divest one of your non-core smaller units, you almost have no chance when it comes to sort of not giving certain things up at the bargaining table. So the focus of my empirical analysis in the study, again, is whether there are performance differences between divestitures to corporate acquirers versus those to private equity firms. And if they exist, which mechanisms can explain these? Is it simply because private equity firms acquire lower quality businesses and you see sort of lower performance of these transactions? Or is there something else happening here? So I'm not going to go too much into detail on the empirics here, as we don't have that much time, but basically I just look at the performance of the cumulative abnormal returns to divestitures to private equity buyers versus corporate buyers. And I basically, I do the selection adjusted regression here, as well as some matching models to try and compensate for the selection that's happening here. I do a lot of supplementary analysis and robustness checks. But basically, the whole point here is in models 3 and 4, and there is a clear negative discount to divestitures to private equity acquirers. But the more interesting part here is that these negative effects are even stronger and more significant for divestitures to private equity firms directly, but not to firms that are themselves owned by private equity, which are much more like typical strategic buyers. In fact, our reviewers have suggested that this is a really interesting distinction and kind of suggested that we investigate this in more detail, that I investigate this in more detail. Actually, sorry, this is my own paper. So I do a lot of robustness checks and kind of investigate additional factors here. And again, I think the kind of one of the core findings is that these effects do not seem to be attributable strictly to selection, that is, differences in businesses that are acquired by private equity acquirers versus corporate acquirers. So there is something else happening here. And sort of what is happening is exactly what I'm trying to figure out in my sort of in the newer versions of the study, and kind of try to isolate specific mechanisms and see if this is in fact due to just the bargaining advantage of private equity, or it may be something else. Also, what's interesting is that these negative effects seem to completely disappear when you look at long-term returns. Of course, this is something to be taken with a grain of salt, because as we know, large public corporations and long-term returns are very difficult to attribute to any one specific transaction. So summary of findings, again, corporations seem to realize negative short-term returns when divesting to private equity firms versus divesting to corporate acquirers. This seemed to be driven largely by direct divestitures to private equity firms rather than firms owned by private equity. Moreover, this does not seem to be attributable strictly to selection. There's something else that seems to be happening here. And I investigate a lot of other factors. There are a lot of really interesting things happening here. For example, just to give you a flavor, experienced firms or firms that hire financial intermediaries, investment banks, etc., in fact, do not seem to benefit from that when it comes to these negative performance. The negative performance effects are basically very difficult to make go away in this case, and not presence of sort of experienced individuals seems to help you here. And again, I'm kind of still exploring the heterogeneity here in all the specific mechanisms, basically just trying to contribute to the restructuring industry and kind of grow in this body of work on private equity and what private equity is actually doing in public markets and how it affects other actors there. And I'm going to finish here and just going to give a quick shout out to our Warden Corporate Strategy and Innovation Conference, which we're going to have in December. Please submit to this if you're interested. This is likely to be an in-person event, so we're very excited about it. I think it will be of interest to most of those present at this symposium today. Thank you so much.
Thank you, Paul. That's wonderful. I'm very curious how you are able to interview and to deeply be immersed in the private equity context. So later, if we have time, I would like to know, because typically we would advise our PhD students to really get to know the firms, the managers that one is studying. So any advice you would offer to our audience, and any of our participating audience is PhD students. I'd like to have you speak to some of that if you can. Our next speaker is Mary. Take it away.
Okay, hopefully you can all hear me. Thank you to Paul and Gwen for organizing this session, and thanks generally to the STR's task force for doing these virtual symposia. I guess that would include Zhao on the call today. So my role is to talk about sort of the state of this literature generally. And so just some comments on kind of where we are in thinking about the limits of public equity markets. And I was sort of in this early, and it was a very lonely place to be. So I'm excited to see lots of people involved in this conversation. This comes a little bit from my perspective, and partly, with that caveat, this is Mary's perspective. And I only have a short amount of time. So general apologies to everybody that I've managed to skip here. But I'm coming at it from sort of this particular problem that I've thought quite a bit about, and that and also thought about with Todd Zenger, But the idea that public equity markets might actually prevent strategies, or at least not support strategies that are valuable longer term, but are difficult to evaluate. And I'm going to come at this from a variety, in my 15 minutes, very quickly, thinking about which kinds of firm strategies are involved, what are some of the reasons and mechanisms that we know drive this, this challenge, how do firms respond, what are some of the outcomes, what are the remedies, what do we know from research about these things, and then some opportunities for future work. And all of this is not as thorough as it could be, but hopefully this will spark your attention, and you can fill in lots of the pieces of this as we go forward understanding this. So, you know, there's been a long kind of stream of research on short-termism going back a few decades, and the kind of and it still goes on. There's some new work on short-termism, but the basic idea that there are pressures from equity markets for firms to focus on the short term at some expense of something longer term value, focus on other stakeholders with different kinds of strategies. And then this work where people have shown that some particular kinds of strategies are difficult for public equity market participants, both investors and analysts. I'll get to analysts a little bit more in a minute. So things like investments in new technologies or novel innovations, strategies with longer term horizons, Todd's work, and then Todd and my work more generally thinking about strategies that are unique, novel, or complex that create these particular kinds of evaluation costs in the market. And then I like the word that Paul Nary and Asim Kal are using in their brand new paper that Paul mentioned, inscrutable, strategies that are inscrutable. Todd and I, a few years ago, thought hard about this idea of the lemons problem in strategy. So an adverse selection problem that kind of might even be at the forefront rather than the moral hazard, the usual moral hazard problem that we think about in agency theory. And the kind of core idea, just very quickly here, was that, you know, to have sustainable, you know, long-term sustainable competitive advantage requires pursuing strategies that are distinctive and unique and difficult to imitate. And it's those same characteristics that make strategies difficult to imitate and harder to understand that are, you know, they're less common, less well-known, harder to observe. Well, those also make it more difficult for stock market participants to evaluate, to understand and value. And this heightened information asymmetries that comes as, you know, investors and analysts don't understand the strategies as well as managers do, leads to stock price discounts and potentially valuation discounts specifically for these strategies that are potentially valuable. So, I mean, I have a much more positive view of managers as sort of intendedly pursuing strategies that create long-term value. Clearly, not all managers are that way, but I'm much less on the moral hazard side of the story. And, you know, what if managers are trying to pursue strategies that will create competitive advantage? Those strategies are going to be harder to evaluate. And so they face pressure to both retreat from and possibly even avoid these kinds of strategies that might create longer term competitive advantage. And then Todd and I also explored how the typical governance mechanisms that people have talked about in research to address moral hazard actually could exacerbate this adverse selection problem, this lemons problem. And so, you know, this is a challenge for thinking about that these strategies that are intentionally intended to be longer term valuable are discounted. And so some of the reasons that are behind this, the mechanisms, you know, it's the difficulty, the information cost to evaluate. It's also that managers, when they believe they're pursuing strategies that will lead to competitive advantage, are going to be reluctant to fully disclose, you know, what is it that's going to make this strategy create value, because it will just invite imitation. These greater information asymmetries lead to, you know, like I said, lower firm valuation. And then analysts play a role in this too. So a lot of my research has been about these sell-side analysts that play a role as public market intermediaries. Part of what they do is evaluate firms within categories. And so they create sort of category consistent expectations. And when firms deviate from those categories, as they well might do when they're trying to create value or respond to new technologies or find distinctive ways to do things that separate them from their peers, those kinds of things create issues for these market intermediaries, and they have more difficulty understanding strategies. And the mechanisms that affect discounting here, that analysts drop coverage if a firm gets too difficult to evaluate. They might lower their recommendations, and these also result in stock price discounts. And then nowadays we have an additional source of market pressure that started to be studied by management scholars, which is hedge fund activist investors. And Rosa Kim, in her dissertation, has worked on thinking about what attracts hedge funds. And Rosa and I have a paper that we're working on right now. But there's starting to be more research on these activist hedge funds. They're different from private equity. They are much more focused on getting involved in the short term in governance or in controlling the firm. And there's been a bunch of research on hedge funds in finance, but not as much within strategy and management. And this is an important area for the future, is understanding the role that these kinds of investors play in firm governance and this kind of pressure on strategies. But what we do know in general from a lot of this research in finance is that they are attracted to companies that have lower market valuations. There's some debate over whether they're good or bad for performance, and kind of the way the research is going now is they improve performance in the short term, but over the longer term, there are these trade-offs. And so while their improvements are very shareholder centric, they may limit firms' abilities to pursue strategies that have longer term value or that are focused on other kinds of stakeholders. And they tend to pressure targets to get acquired. That's often the exit strategy that they want. And so they clearly pressure changes in strategy. So a very obvious form of how this is working. Okay, outcomes. So what happens? How do firms respond to these kinds of market pressures that arise? Well, one is they just retreat. They face these pressures. They just give up on these longer term strategies. This will happen even faster with hedge funds as the management gets overthrown or the board gets replaced. There's a potential for them to avoid long-term. So some strategies might not even be observable because they were never pursued, but they might have been valuable longer term. Ranganathan and I did some work showing that firms try to offset illegitimacy. So they might persist with these strategies that analysts and investors are questioning. And at the same time, they do these very shareholder-focused kind of activities that say, look over here, don't look at the strategy, but look over here, we're doing these things that you care about. And then other outcomes, firms might persist with their strategies more or less, but go private. This would be sort of the Dell example. And this is the private equity story, private equity as a remedy, which Rosa, Kim, and I are also working on. And the idea here, and very much what Paul was talking about, you might have sophisticated investors who have the ability and motivation to really understand the value of firms' longer term strategies. And private equity investors may play that role. They might have access to more information in addition to have more ability, more motivation to really understand the value of strategies. And just like Paul said, what his paper was about, these three advantages, it's right in the abstract about what the possible advantages that private equity can create would be. And then finally, firms might end up being acquired by a strategic corporate buyer. That also might be the result of hedge fund activism also. So lots of different possible outcomes that come from these market pressures. The ones on this page tend to partly explain this dramatic reduction that we've seen in publicly listed firms over the past decade. So big important implications for strategy, that if you're a manager trying to pursue strategies that will get you competitive advantage longer term, because they're difficult to imitate, you're actually inviting a lot of these issues, a lot of these pressures from public equity markets, and these strategies might be abandoned or not pursued. So what are some remedies? Well, people have talked about this idea of sophisticated, longer horizon investors who can truly kind of understand the intrinsic value of strategies. And the most recent version of this is Paul's great work on private equity, but it's also related to a longer stream of work on how different kinds of investors pressure differently. And Gautam's paper is sort of at the other end of the spectrum, right? That the investors that don't have the ability or motivation or don't have the incentives to actually understand the value of strategies are kind of gonna not help unlock managerial incentives to pursue these longer term strategies. But Alex Edmond's work on how if you have sophisticated block holders, they can get the stock price right just by continuing to hold shares for firms that they understand are making good decisions. You know, some investments or some performance, some decreases in profit performance are because firms are doing badly, managers are doing badly. Others are because firms are making really good investments in something in the future that's going to create value, and certain kinds of shareholders can sort that out and help get the stock price right. That's the gist of that work. Ram and I did some work on showing that the pressures are different for firms that have been previously categorized as growth versus income. And you get a lot more leeway if you're a growth stock. And a question is, if you can get yourself into being considered a growth stock, that might be a good way to remedy the situation. And then Brian Boucher's work from a while ago that Gautam also mentioned, that different kinds of investors have different effects on tendencies for firms to reduce their R&D to manage their earnings. There's the potential for impression management. There's some work on that. There's some potential for signaling. There's lots of work on signaling. And so there's lots of opportunities for future research in this area. And I would say one opportunity, I didn't know about Paul's new paper, but one opportunity is to think about, you know, what are the long-term consequences? What are the strategic choices that firms make and the long-term consequences of these strategies with different kinds of investor ownership, now considering private equity and hedge funds and comparing it to public equity markets. Very hard to study, just a rat's nest of endogeneity, but it would be very interesting to understand, you know, what kinds of strategies don't appear in certain types of investment structures, governance structures. And then, because we're strategy people, you know, there's a lot of opportunity for thinking about what can managers do to somehow pursue valuable long-term strategies in public equity markets, to somehow not reveal all of their sources and paths to competitive advantage, but to you know, somehow enable the pursuit of these potentially value creating strategies despite these pressures from public equity markets. And one thing that Ram and I did, we have this paper thinking about Verizon, how Verizon actually tried as it went into fiber to the home, broadband to the home, and made these investments that investors were very negative about, analysts were very negative about, how it actively worked to shift itself. And I say that's sort of the tagline of this paper is, think of us as a growth stock. It sort of shift the way that it was evaluated to be seen much more for growth in revenue and not so much profit bottom line performance. Okay, I went a little over, but I talked fast and basically got this in about 15 minutes. So thank you very much.
Thank you, Mary. I've been fascinated by the lemons problem and the remedies to those problems. Looking forward to talk more about this issue of information asymmetry and disclosure. Okay, next we have Todd. Todd, I would like to ask you to unmute, please.
I think we'd get better at this. You'd think we'd get better at this. Sorry, my apologies.
No problem.
My thanks to the organizers of this event as well, and it's been wonderful to think about these issues again in light of a bunch of new research and things that have been going on. My agenda, what I'd like to do is I'm tasked with sort of being a discussant and maybe also a presenter. And so I'm going to start out by commenting on the two empirical papers that have been presented, and then with whatever time remains, I may say a little bit about just my broader comments about how thinking about ownership has become much more complex, and then a little bit about kind of what is the problem that we're trying to solve with private equity. So first, let me start with Paul's paper. The thesis here is that divesting firms will generate higher performance when they sell to essentially strategic buyers, publicly traded firms that are strategic buyers rather than private equity firms. And the subtext here is that publicly traded firms are able to generate more value when acquiring these divested assets, and that divesting firms therefore obtain more value when they sell to publicly traded firms. And this is, they essentially find corroborating, or he finds corroborating support for that thesis in a study of more than 1,000 divestitures, that these PE buyouts underperform using an event study methodology in the short run, although he doesn't see the same kind of effect in the long term. And I just sort of would note that this is, and Paul made this point, this is part of a larger project sort of looking at PE acquirers and publicly traded strategic acquirers. So Mary used this phrase, the rat's nest of endogeneity, and I want to sort of say that I think it is a rat's nest, but I think we are, in some sense, spending too much time trying to solve it when the story with it is just as interesting as the story that you might be able to tell if you were successful in really teasing these things apart. So I think the good news is, the bad news here is that, and Paul in other work has pointed this out, that the selection effect is huge here, right? That we know PE firms are buying very different assets than strategic buyers. And to think that we're actually going to, through some matching technique, really distinguish this, I think is really optimistic. But I think the good news is I'm not sure that it really matters. In some sense, how different is the narrative if this is a selection effect? Can we, and really, can we disentangle this selection and treatment effect here? So we know strategic buyers have access to synergies, that PE firms tend to be much better at sort of wielding discipline on these assets. As a consequence of this, they choose different targets. It's, as I said, it's really hard to believe that you can empirically tease this selection piece apart, because it really requires you believing that the PE firms and the strategic buyers screwed up. That is, they made bad selection choices such that you have the variance that you need to be able to tease apart the treatment effect, right? You have to have these errors in their choices in order to even see a treatment effect. And so just thinking about this more deeply, is the advice for a firm to sell to a strategic buyer with synergies? Is that what you conclude from the study? Well, it's not. It's probably not that. Rather, the advice is that you ought to build a business that's attractive to a strategic buyer and not one that needs to be turned around through greater discipline. So is that a treatment effect? Is that a selection effect? In other words, the strategic implications for sellers is to take advantage of the selection effect, not the treatment effect, because the selection effect here is far bigger than the treatment effect. Now, this gets a little bit circular in the sense that I know, I know what the strategic buyer can do, and therefore I'm building this business that a strategic buyer might be interested in. So is that a treatment effect or a selection effect? It's actually very difficult to sort of disentangle these two things. I think relatedly, it's important to keep in mind that this event study methodology is, built around this idea of the returns are based on newly revealed information, right? The baseline is what's the current information, and the performance effect is all about what's the new information that's being revealed. So the returns you observe are returns to new unexpected information embedded in this divestiture announcement. And so I think that the information that's being revealed in these two types of announcements are very different. So the information, if you're divesting to a PE firm, is essentially, this business is worse than we thought, or worse than you thought as an investor, and therefore, the new information is we're going to offload this thing because, we don't have the capability to turn this thing around. Whereas the news, if you're able to sell it to a strategic buyer, is, hey, there's somebody who thinks this thing is worth even more than it is to us. And so just at the very outset, this is, one's sort of positive news and one's sort of negative news. Again, the question is whether the news that generates your result is about the state of the business when it's sold, or about the prospects for change post-sale. That's trying to tease apart the treatment versus the selection. And again, I'm just not sure that it matters. Either way, the story is really interesting. I think the story's the same. It's about two firms with very different capabilities, matching those capabilities to available assets that that fit those two capabilities. And I think we get a little bit hung up in trying to separate out selection and treatment when I'm not sure we can, and I'm not sure it actually changes the broader story that you're trying to tell. Anyway, it is a great topic, and it's a great study. And I understand you kind of have to respond to the reviewers that have taken up this paper, but I just think that we get hung up a little bit on this separation between treatment and selection in a way that may not be productive for telling the overall story. All right, a few comments about this interesting study by Gautam and Cassidy. Here again, just the thesis: concentrated ownership, such as institutional ownership, may solve this diffuse ownership problem that has plagued public equity markets. That problem is that managers are lazy and inclined to pursue low-risk, non-explorative paths to value. And large institutional investors are going to come in and sort of create these right incentives that will solve this problem. And their story is sort of, well, hold on here. Now, close to 35% of all institutional shareholdings are passive owners, like these index funds. And these owners are not wielding discipline. They're not really doing exactly what we're saying these institutional owners might be doing to solve this moral hazard problem. And so, does active versus passive ownership of a corporation affect managerial decision making, and in particular, does it affect risk taking and the pattern of R&D investment? And the answer is yes. It tends to dampen explorative R&D, even though overall R&D levels investment remains the same. So very interesting thesis and some pretty convincing results. I think here again you run into this same selection, and Gautam mentioned this selection versus treatment problem. Are passive investors dampening incentives to invest in long-term R&D, or are passive investors choosing firms with more stable exploitative R&D? Is this treatment or selection? again, I'm not sure that it matters, because the story is essentially, the outcome is the same. If passive investors, I mean, it may actually matter here a little bit more, but if passive investors are willing to just take you up and invest in you, regardless of, how explorative your investment is, it might encourage you to try to court those investors. And is it, is a selection or treatment? Either way, the effect of more passive investors is to cause firms to reduce. And whether it's selection or treatment, it doesn't matter. It doesn't have to be an effect that happens once those passive investors are in place. It may be a behavior change in the part of firms that's being used to court those passive investors. And I think it's going to be really difficult to tease them apart, but I'm not sure that matters. The storyline is the same. Okay, that's comment one. And I think you actually may do this a little bit, but I just wondered whether you can distinguish between types of passive investors and try to get at this mechanism a little bit more carefully. There may be some of these passive investors who are more passive than others. That is, some who select and then remain passive, and some that simply are just index funds. They just choose for the category. Others that are, they actually do select who to invest in, but once they select, they're not really doing much to move money around after. And that might be a way to get at a little bit this selection versus treatment, although I realize that statement's just undermining my first point, which is that it may not matter, but you might be able to get at it a little bit here. And then one final comment here is that I just, in reflecting on this, these index funds are clearly a dream for legitimacy, kind of category scholars. The message here is that all you have to do is remain in a category and you're assured of investment. And it would be interesting to see, other broader, kind of implications. Do you see efforts to sort of just, all we have to do is stay in this category and we are assured of getting, this kind of investment? And are there other ways in which we see this behavior change, occurring? Because clearly this is, emphasizing these categories in a way that we perhaps have not seen that in capital markets. Okay, just a few broader comments. So one is that equity markets are not as simple as we think, and maybe becoming more complicated and difficult to categorize in and of themselves. Private equity is only sometimes actually private. In fact, the top 3 private equity firms are all publicly traded now. So it's sort of, the model is private equity, but they're actually not private, which I think is important to think about. So that it isn't so much about the privateness as it is the model, maybe. Of course, we know this, that not all ownership shares are equal. And as we sort of place this emphasis on concentrated ownership, the whole dual class share movement has its own capacity to keep, ownership doesn't need to be concentrated if the shares you have are worth 10 times more voting power than somebody else's shares. In 2019, of the top 10 IPOs, 7 of those 10 had this dual class share structure, which I think is, again, something that we have to think about and understand more deeply. I think if you went back 20, 30 years ago, it was unanimous consent was dual class shares are evil. They're destructive to share, to shareholder value. Clearly that story has to be much more nuanced today when you see 7 of 10 new IPOs with these dual class shares. Concentrated ownership does not mean greater control. This was a slide I lifted from Gautam's presentation. These passive investors, are clearly changing the face of what it means to have institutional owners. And then finally, I think in this very fascinating story that's played out over the last few months, where a hedge fund has taken a tiny share, a 0.02% share in Exxon, has spent $30 million wielding a proxy. It was basically an election process to get, they sought to get 4 of their shareholders on the board of Exxon. I think they succeeded in 2, maybe it's still uncertain whether it's 2 or 3. And, so here's a very, very small minority shareholder through a very public process, sort of social media, actively involved, trying to court investors to vote in their direction. Also very interesting in this context is that this activist investor cloaked itself in green, and how serious they were in sort of trying to be a green investor, as opposed to this being just a charade to try to get in and sort of change the ownership and change the decision making strategically. This company is uncertain, because most of the board members that they were proposing are oil and gas executives from other firms. These were not, this was not Greenpeace, directors that they were trying to get on this board. So very, very, very interesting, I think, pattern. Okay, let me, in just a few minutes, just talk about this last issue. And this is, so I think there's really an issue about what problem is private equity or concentrated ownership trying to solve. And these papers had a little of this theme to it, certainly more, Mary's in particular, that it may not be this moral hazard problem. It may not be you're using concentrated ownership to give, to create the kind of high-powered incentives that will motivate managers or discipline managers in the way that they have not been disciplined in the past, that in fact it may be an information asymmetry problem or an adverse selection problem. It may be actually lazy, effort-averse investors and poorly motivated owners who are unable to evaluate managers' genius, right? It may be a very, very different story, in that concentrated ownership is what motivates owners to dig in and figure out what's going on. And, so Mary sort of spoke about that. Another one, and this is clearly somewhat related, is that perhaps what's going on here is really about shifting ownership concentration, changing the competence of those who own. Whereas under the moral hazard assumption, it's basically a belief that the wisdom about what should be done in a corporation exists with the investors, and all you need to do is discipline some robot to actually execute what these visionary investors think should be done, and all will be well. The ownership, kind of incompetent story is that what you've got is incompetent people owning those assets now, unable to put in place the right kinds of managers perhaps as well. And that what's going on is that you're seeing a shift in who actually owns and the competence of those that actually own these assets. And that's really the problem that's being solved in this churn in ownership and shift to private equity. And this is not the whole piece, not the whole story in this paper, but part of this project that myself and a few co-authors have done, a piece that appeared in Strategic Management Journal recently. And again, it's sort of saying the story is not about moral hazard. We're not just trying to fix incentives, and once we fix incentives, everything will work right, and therefore managers are just sort of these robots trying to heed the wisdom of what's coming through from investors. But the alternative thesis is that the primary path of value creation is, again, not reshaping incentives, but rather it's shifting ownership to those competent to wield ownership rights. And the underlying logic here is that alternative owners and a host of other economic actors all have very divergent theories about what should be done with assets and activities, and they're constantly composing theories and their understanding of causal relationships about how to create this value. And there's enormous uncertainty as to the accuracy of these theoretical narratives. These theories and beliefs are difficult to trade and sell in strategic factor markets. It's very difficult for me to convince you that you ought to take on the theory that I have about what should be done with these assets. And this paradox that Mary talked about, which is that the most valuable theories about what should be done, the most are likely to be unique and the most difficult to sort of trade and convince others to take up. Therefore, any economic actor that has such a theory needs to take on ownership to test it, because others have other beliefs. And what ownership grants you is the right to do with those assets that which you think is value creating. And ownership then creates value when ownership is granted to those particularly competent in composing theories of value and sort of in organizing their pursuit. And that with ownership comes the right to pursue whatever theory you want, to alter that over time, abandon it, and ultimately to potentially sell these assets to somebody else that has some other theory about what should be done with them. And, from this, we, in this paper, sort of compose this idea of owners having three basic types of competencies that correspond to these three ownership rights that they have: the rights to decide what assets to own and this capacity to compose these theories, and we call this sort of a matching competence, a governance competence, that is your capacity to organizationally execute that which you conceive of, and then a timing competence. This is your capacity to time when to acquire resources or when to sell those resources. And I'm going to, in the interest of time, just skip these and let you look at this elsewhere. But this sort of describes what is matching competence, governance competence, and timing competence, and that effective owners, the most effective owners, of course, possess all three of these competencies. And if they don't possess these competencies, what great owners do is they seek outside resources to shore up their inadequacy in those competencies. And if you're not an owner, other kinds of economic actors, activists, investors, hedge funds, investment banks, professional managers, are essentially trying to take advantage of ownership incompetence. That is, if you're not good at timing or governance or matching, there are all kinds of other actors circling around you, either trying to take ownership and do what you're not doing, or trying to provide you with advice and guidance to shore up your incompetence in one of these three categories. There's some interesting implications in thinking about this idea of ownership competence, and as it relates to sort of ownership concentration, which is the key remedy associated with private equity. And that is that if you are a competent owner, then ownership competence elevates the value of your enterprise. But if you're an incompetent owner, that's the worst. Ownership concentration is the worst possible outcome. You're just empowering someone particularly incompetent. And so whether concentrated ownership is a good thing or bad thing, whether more institutional ownership or whatever it might be is good or bad, all depends on how competent the management is. I'm going to skip these two slides so we have a few minutes for comments. And just my final thoughts would be changing ownership or concentrating ownership is much less about shifting the incentives as it is empowering those competent to own, including competent with theories about what to do. Core theories, I'm going to skip that one. Competent owners recognize their incompetence and they go out and find ways to shore it up using other actors, investment banks, consultants, professional managers. And finally, that the market for corporate control is about pairing assets with competent owners rather than, I should say, incompetent ones. And that this is an extremely important vehicle through which private equity and other forms of shifts in ownership are creating value. All right, I will stop there.
Thank you so much, Todd. This is amazing. I have provided in the chat room this article on ownership competence. This is published this year, 2021, in case you would like to do further reading. We don't have enough time to do a full discussion about it, but I do see that there are several questions that were raised. So if Sam Garg or Daniel Kim or Satya Vijaya Kumar, you would like to raise your questions, feel free to do so. And if you want to use your raise hand function, I will also take your question.
Well, since nobody's speaking, I'll take the opportunity. So thank you very much, presenters. I really enjoyed this. I do not really work so much in private equity or public space, but I do work on venture governance and have been doing sort of trying to go to public side, and I'm very excited. So one thing I wanted to say, ask Gautam and Cassidy is, when you think about the owners, I mean, it's not just passive, right? So it's a portfolio of different types of owners, right? So are there different ways to dissect that? I mean, like engine number one was an example that was coming to my mind, and Todd brought it up. So is there a way to sort of see it a little bit differently and slice it differently? And like Mary also pointed out, that active investors also find it actually difficult to affect firms to do exploratory innovation, right? So this choice about passive investors, I mean, would it help you if you actually talked about both, or would that not be helpful in making the broader point about changing contours and other things you mentioned?
Sure, Sam. Great questions. In fact, I think in part we began with that perspective, but found that it becomes complex very dramatically. And in the shortened presentation, we couldn't go into all the details. But even when you look at passive investors, there are 4 different flavors, and that we distinguish. And empirically, I think we're the first people to do that. It was an incredibly labor-intensive task. And in the end, and we also look at various flavors of active investors. But in the end, we found that our overall conclusions about passive investors did not change no matter how we diced and sliced the data. But each one of them had a separate sort of story. So it's more like a book length treatment that would sort of, and I'm not even sure that would be it. It would need multiple papers to kind of address that. So what we ended up doing is that we used since we posit fairly specific mechanisms of legitimacy that might affect the behaviors, what we ended up doing is that within passive, investors, we find variance in the degree to which those mechanisms are actually possible given those various passive investors. And so that gave us the basis for essentially a placebo test, is that we see that pure index investors are more likely to do all of these things we talk about. And then, these other variations of quasi, and people haven't made that distinction. In fact, even Ahuja and Van Reenen and Zingales did not make that distinction. They just talk about this group collectively. And we find that actually, exactly as our arguments would predict, it works for this group, but does not work for other groups, because the underlying theoretical mechanisms that we're talking about are not applicable in that. And we actually also, in other work, we also incorporated, the AVZ also had this notion about, product market competition and so on, etc. And we account for all of that, but then that just complicates the story. It doesn't change the fundamental result. But to your point, actually, it's opened up this whole, you can call it a can of worms, or in our academic world, we call it opportunity, because now it opens up the world to these other papers, which at some point of time, hopefully, we will get to. Yeah.
Great, thank
you. But great observation. It's exactly what, that was how we started, and eventually just the complexity just drove us to this narrower thing, and then specifying the mechanisms. Because the other thing that I do want to make a point here is that very often when people are trying to address endogeneity, they're trying to say, and I think Todd made this point very beautifully, they are separate, it's the opposite of what Todd said today, is that they don't separate what are the underlying mechanisms that might happen, but they just say, is something causing something, and almost sometimes in a Granger sense. And we're able to do that by saying that, look, if these mechanisms were not at play, you should expect to see this everywhere, but you don't see it everywhere. Okay.
Great, thank you. Look forward to seeing multiple papers.
So on that note, Gautam mentioned can of worms and opportunities for further research. So I want to thank the presenters, the discussant today for a wonderful session, and stay in touch. We will see you again in July. Thank you so much.